So, double entry. Today we want to talk about the effect of cash transaction to our double entry. So, the cash is already in the business. That means capital has made us to have cash. The owner of the business has put capital into the business, which becomes an asset for us in terms of cash. So, what we have to do with this cash, it's now what we want to work on now. To get it. Cash is liquidity, so it is important for the business. So cash will go in, cash might come out. But most of the times, cash goes out of the business. So whenever cash goes out of the business, there should be a double entry transaction for that. That means if we have put cash out for the business, something should have come back in return. So that is what we need to talk about. So here they said the proprietor starts the business with $50,000 in cash on January 1. So the proprietor, that's the owner of the business, has started the business with $50,000 or 50,000 euro cash, which means the transaction, we're going to have double transactions here. We're going to have double entry. We're going to have our cash account reimbursed with 50,000 by the capital. Capital is the owner of the business. The amount of money the owner of the business has given to the business, that's capital. And so here we have our capital account and the cash account. So the cash account becomes an asset for the business. The capital is the equity account. So the two transactions here have cash account, which is going to be a debit entry because cash has come into the business through capital. So you're going to debit cash account and credit capital account. I think it's clear. So here we have 50,000 additional cash in the business.
Where is that?
Yeah, that's 50,000. The owner of the business, the proprietor gave the business 50,000 in cash. January 1.
Yeah.
Did you see it now?
Yeah.
So the effect of the transaction is that our asset of cash has increased by 50,000. And we have increased our equity also by 50,000.
Yes.
I think it's clear. So we debit cash account because cash has come into the business, and we credit capital account because capital gave the money to the cash. Is it clear? Yeah. So the transaction is done. You debit cash, you credit equity account or capital account. That is done. Then the next transaction, they said, the business go down, please. Business buys equipment for 4,200 cash on 2nd of January. Are you there?
Yeah.
Okay. So, are you there, please?
Yes.
Okay. So the business buys equipment. So equipment is an asset for the business. Through cash. So two things, the double entry here is that our asset of equipment has increased and our asset of cash has decreased because we've used cash to buy the equipment.
Okay.
Do you get it? So here, because cash is paying for the equipment, you credit cash, you debit equipment that has come into the business. You get the double entry there. Cash has reduced by the amount of the equipment, but equipment has been added to some of our assets, our fixed assets in the business. Is it clear?
Yes.
So the double entry, I said it already. You debit cash, you debit equipment account, you credit cash account. Clear, right? The next transaction, you go down, please. The business buys goods for resale for 5,000 euros, paying by cash on 4th of January 2017. Yes. So we buy goods for resale. When you buy goods for resale, we call it purchases. So we're going to have double entry also here. We're going to have purchases account and cash account. Are you with me?
Yeah.
So here, our asset of purchases has increased and our asset of cash has reduced because we paid through cash.
Yes.
Do you get the point? So you debit purchases account, you credit cash account. Cash account is out, purchases is coming in to the business. Is it clear, please? So go down again. The business buys a motor van. Are you there, please?
Yes.
The business buys a motor van for 10,000 euros, paying by cash on 5th of January 2017. So here we bought motor van. So we have our asset of motor van increasing. At the same time, our asset of cash reducing.
Yes.
So we're going to debit motor van account and we're going to credit cash account. Any question about that?
No.
Okay. So that means our asset of cash is still reducing there because we bought a motor van. So the next transaction, let us say the business transaction to date. So we're going to have, how many accounts are we going to have? We're going to have cash accounts, which will comprises all the items that we purchased. Equipment, purchases for the stock or stocks that we purchased, motor van. They're all going to be on the credit side of our cash account.
Yes.
Because these are what we paid for. So your cash account is going to have a credit balance on equipment, a credit balance on purchases, a credit balance on motor van. Then your equity account will have a credit balance on cash because the first money that the owner of the business gave to the business was the 50,000. So your capital account or equity account, we have a credit balance of 50,000.
Yeah.
Then we have the individual accounts.
Yes.
Equipment account, we have a credit of 4,200.
Mm.
Do you get that? The purchases account, we have a credit of 5,000. Then the motor van account also have a credit of 10,000.
Yes.
Do you get it?
Yes.
So that's going to be the summary of all the transactions. You know, in our cash account, we have each item. We have equipment account, we have purchases account, we have cash account, motor van account. All these things has received that cash. That's why we have it. I think it's clear. So cash is going out because of equipment. Cash has gone out because of stocks that we bought. Cash has gone out because of the motor van account. Any question about that?
No.
Okay. So here they said, this example introduces both cash and bank transaction. Once on the debit side of the account, remember that each item has to be entered twice. Once on the debit side of the account, once on the credit side. Are you down? Okay. So they said, the order in which you enter the transaction does not matter. We've talked about that in the law of principle or the principle double entry principles. But it is often easier to deal with the monetary aspect of each transaction first. So it said, decide if the money is going in or coming out and enter the item into the cash account or bank accounts. So the first thing you have to put in order, yes, it's better you put monetary transactions ahead of other transactions that are not monetary. So as soon as you have your transaction, what do? You decide, is cash going out or coming in?
Mm.
So if you have concluded in your mind that cash is coming in, then you debit. If you think of concluded that cash is going out, you credit. I think it's clear. Enter the item into the other account on the opposite side. So because now you bought equipment with cash. So that means cash is going out.
Yes.
So on this credit side, or in your cash account, on the credit side, you credit it as equipment. That is what they are saying here.
Mm.
Cash will be there, but on the credit side, because you've used it to purchase equipment.
Yes.
Is it clear?
Yes.
So we have a business transaction here. A business transaction for July 2017 as shown below. They said, started business with 20,000 cash. So when you start business with 20,000 cash, it means you're going to have cash account and capital account.
Mm.
So cash account will have a 20,000 debit entry.
Yes.
Capital account will have a 20,000 credit entry. I think that is clear.
Yes.
Do you understand the first point there? So on your cash account, you're going to have 20,000 on the debit side. On your capital, you're going to have 20,000 on the credit side. The details will be, for the debit side, you have capital. On the credit, for capital, you have cash on the credit side.
Yes.
Is it clear?
Yeah.
Okay. So now, then they said open a bank account and deposited 19,000 of the cash into the account. So here, we're going to have bank account and cash account. Bank account, you've deposited 19,000 of the cash into the account. So your bank account will have 19,000 cash on the debit side.
Mm.
Do you get it? I think that is clear, right?
Yes.
Great. And on your cash account, because you took 19,000 from your cash into the bank, so your cash account will have 19,000 on the credit side.
Yes.
Clear, right? We paid rent for premises, 500 euros by check. So you're going to have rent accounts there. You're going to have rent accounts to be debited and rent account to be credited and bank accounts, rent account to be debited and bank account to be credited. I think it's clear. Then the next one, we have bought goods for resale and paid by 3,000 check. Purchases, that is purchases. You purchased goods. So we're going to have purchases account and bank account. Your purchases account will be debited for 3,000 and your bank account will be credited for 3,000. I think that is clear. Pay 2,000 by check for a second-hand van. So we're going to have our van account and bank account. The van account will be debited for 2,000 and the bank account will be credited for 2,000. Clear, right? So some goods for cash. So your purchases account, now you've sold some goods, right? So you're going to have your sales account now. So you're going to have your sales account debited for 600, credited for 600. Your cash account will be debited for 600 because you sold out. So that is the credit for sales and debit for cash. Then we have bought fixtures and paid 800 by check. So we're going to have fixtures account and bank account. 800 is going to be debited to the purchase fixtures account. 800 will be credited in the bank account. Paid motor expenses by 65 by cash. The expenses account. That's other, or you can call it, expenses account. You will credit it with 60. You will debit it with 65 and credit your cash account by 65. And the last one, sold goods for 2,000 and receive a check which was paid into the bank. So your bank account has received 2,000 euros. That means you debit the bank account and you credit the sales account. So that's the end of all the transactions. Is it clear?
Yes.